I think you have a recession which has been delayed by an enormous amount of stimulus coming from the fiscal side and monetary side. But that can delay a recession, but you cannot deny it eventually. And that is what is coming.
Hey there, welcome back to Cash Baggy. Today, let's talk about Komal Sri-Kumar, the president and founder of Sri-Kumar Global Strategies and the former chief global strategist of Trust Company of the West, said, "You can delay recession, but you cannot deny it. Recession is a must, and it's coming." It's a perspective that challenges our understanding of economic cycles. Don't miss the chance to understand better the forces shaping our financial landscape. Let's begin. According to the New York Times, the bear market came and went in a hurry as the pandemic took hold, replaced by a bull market that has looked increasingly fragile. Stock indexes surpassed their pre-pandemic highs during an eventful third quarter, but spectacular gains in a handful of giant technology companies carry them aloft. At the same time, returns for the rest of the market were so-so. Some portfolio managers and strategists are bypassing the tech giants and looking for opportunities in market segments that have yet to ascend appreciably, smaller companies, so-called value stocks that move in concert with the economic cycle and foreign countries. Some high-flying stocks are likely to get hit, and hit badly, said Komal Sri-Kumar. The decline that began in September seemed to make perfect sense, given the fraught economic and political backdrop, and to have come out of nowhere. The S&P 500, which rose 8.5% in the third quarter, continually reached new highs during the summer, and so did the tech-heavy Nasdaq Composite Index. However, the rally was growing more narrow. Regarding the two-day Fed policy meeting, market expectations lean towards an unchanged interest rate decision this month. Komal will guide us through the Fed's position and potential yield trends. His perspective on the current economic landscape is rather grim. Let's hear him expand on the possibility of a full-fledged recession looming by year's end.
To you, the signal is coming very clearly from the bond market, especially the Treasury's yield, the 2 to 10-year yield curve being inverted starting July of last year. So we have been inverted for quite a while.
Komal provides a sobering perspective on the economy, emphasizing that extensive fiscal and monetary stimulus can postpone a recession but cannot avert it entirely. The warning signals are difficult to ignore, particularly from the bond market and the inversion of the 2 to 10-year yield curve since July of last year. His insights remind us of the importance of heeding economic indicators and preparing for potential challenges. During his CNBC interview, Komal addressed a recurring client question regarding the delayed arrival of a recession despite yield curve inversions occurring over a year ago. He highlighted a crucial distinction in the current situation: the absence of the substantial stimulus measures seen in previous inversion periods.
I face the question from clients from time to time, if that has happened and it is 14, 15 months ago, why haven't we seen a recession yet?
Right.
The change that we have this time is we have not had enormous amount of stimulus at the same time as in the past cases of inversion. So that's why I think it is getting delayed. But clearly the signs are that there is an exhaustion in terms of the economy, and that is going to show itself in terms of a recession.
Komal brings up a crucial distinction in the current economic scenario that sets it apart from historical patterns. In previous instances of a yield curve inversion, there was typically a substantial injection of stimulus measures into the economy. These measures aim to counteract the impending recession and stimulate economic growth. However, this time there hasn't been a massive parallel stimulus effort accompanying the inversion of the yield curve. According to Komal, this unique circumstance is a significant factor contributing to the delay in the usual recessionary indicators. The absence of large-scale stimulus measures has effectively postponed some warning signs that typically precede a recession, giving the appearance of a delayed economic downturn. Nevertheless, Komal believes that despite the delay in these indicators, there are unmistakable signs of economic fatigue and strain emerging within the current economic landscape. These signs are becoming increasingly evident and concerning, and they strongly suggest that an impending recession is a real possibility. In summary, Komal's analysis highlights the absence of extensive economic stimulus measures as a key differentiator, explaining why the recessionary indicators appear delayed. Despite this delay, the accumulating evidence of economic stress points to an impending recession, making it a matter of growing concern for experts and investors. Now let's focus on the indicators drawing Komal's attention. You may be curious about the specific signs that Komal is emphasizing, especially in light of the apparent strength in various economic indicators. When you consider the job market and various other factors, it may appear that we've managed to rein in inflation to some extent. This has led to the belief that the Federal Reserve's actions might be nearing completion if they haven't reached that point yet. However, let's hear Komal's observations beyond the fluctuations in the 2-year Treasury yield.
Let's look at other things. One, the manufacturing growth has been down. It's been negative for about 5 or 6 months in a row. The S&P global expectation of the economy has also been down. The consumer sentiment coming from the University of Michigan, the latest number was down, which was also not expected.
Komal pointed out several critical factors warranting our attention. Firstly, he highlighted the persistent negative growth in the manufacturing sector, which has endured for approximately 5 to 6 consecutive months. Secondly, he drew attention to the declining economic outlook, according to S&P Global. Thirdly, he mentioned the unexpected drop in consumer sentiment, a finding reported by the University of Michigan. These factors collectively suggest that consumers, upon whom we rely heavily for 70% of GDP, may be reaching the limit of their spending capacity. This change has been gradual due to the significant government stimulus provided to consumers. Still, it seems that a shift in this dynamic is imminent. Turning to the topic of inflation, Komal also acknowledged the decline in core inflation. Still, he emphasized his central argument regarding headline inflation. While central banks typically focus on core inflation figures, which exclude volatile elements such as fuel, energy, and food, the situation is evolving. As Andrew discussed earlier, domestic gasoline prices are trending upward, closely aligned with the movements in Brent and WTI crude oil prices. This trend is expected to persist, affecting gasoline prices and contributing to an increase in the headline inflation rate. Now let's turn our attention to the Fed's response in a scenario where they must grapple with both an economic downturn and a resurgence of inflation at the headline level. Will they hold steady, raise rates, or resort to rate cuts?
Because the problem is the European Central Bank has one mandate, inflation. The Fed has 2 mandates, and essentially it's illogical. You can't deal with both of them at the same time. You have to give up on one of your targets. So I think because of the fact that you may have a recession plus inflation staying high, the Fed has to decide what to give up.
According to Komal, the problem lies in the conflicting mandates of central banks. The European Central Bank focuses solely on inflation, while the Fed juggles 2 mandates. This dual objective presents a challenge, as it's often illogical to simultaneously address both. In the face of a potential recession coupled with persistently high inflation, the Fed faces the dilemma of prioritizing one target over the other. In Komal's recent analysis, he suggests that given the upcoming elections within a year, the Federal Reserve might choose to prioritize addressing inflation. This isn't simply about accepting a 3.5% inflation rate as a target. It involves potential consequences for the Fed's credibility. Instead, Komal envisions a scenario where the Fed decides to raise interest rates in November after a brief pause in September. Following this increase, there could be a prolonged period of stable interest rates lasting into early 2024 with no further rate hikes. However, the path of rate adjustments also depends on external factors, like the occurrence of a significant credit event. If such an event transpires, the Fed might rapidly change its stance, as seen during the banking crisis in March. This led to a swift stop in quantitative tightening, with the Fed's assets swiftly returning to levels seen the previous November.
Don't listen to the equity market. Look at October of 2007. The equity market, the S&P 500 hit a peak, record level. But the bond market was suggesting a recession, and in the case of the economy, the bond market is a better predictor than the equity market is.
As Komal said, listen to the bond market, and also one more, don't listen to the equity market. The S&P 500 hit a peak record level. but the bond market was suggesting a recession, and in the case of the economy, the bond market is a better predictor than the equity market has been. When it comes to understanding economic trends and potential risks, it's crucial to pay attention to the signals emanating from the bond market rather than relying solely on the statements of Fed officials. As history has shown, the bond market often provides more accurate insights, making it a valuable barometer for investors and policymakers. So the next time you want to gauge the economic climate, carefully listen to the bond market's whispers. Thank you for watching. If you found this helpful, please like, share, and subscribe. Stay tuned for my upcoming videos, where I'll continue to explore insightful topics like the inevitability of recessions and their impact on the economy.